So we have our three tools. Let's take a look at the first tool, the accounting equation. What is our accounting equation? Assets equals liabilities plus equity. Now, equity, I choose to just say equity because it's just easier than saying stockholders' equity or, something along those lines. It's the same thing as stockholders' equity, folks, so don't freak out. And you can make it a little acronym a little better. ALE, ALE. Assets equals liabilities plus equity. Now, the thing about this equation is that it must stay in balance at all times. And so when you look at it here, think of it like a balancing scale. Our assets are on one side of the equal sign. Our liabilities and equity are on the other side of the balancing scale, and they must equal the same. So my total assets are supposed to equal my total liabilities and my total equity added together. So how is the equation used? It is an organizing tool for business transactions. Yes, this is where the math comes in. It is an algebraic equation to calculate our increases and our decreases in our individual accounts. And this equation must stay in balance on both sides of the equal sign. So one side of the equation cannot be more or less than the other side. Let's take a look at how this works. So here we have an example that we can use. Be the One is a motivational consulting business. At the end of its accounting period, December 31st, 2013, Be the One has assets of $395,000, liabilities of $97,000. So using the accounting equation, we need to determine the following amounts. What is the equity or stockholders' equity? And let's say the stockholders' equity, assuming that assets were decreased by $65,000 and liabilities increased by $30,000, $36,000, what would the stockholders' equity be then? All right, so let's address the first one. So we have our accounting equation on the screen. Remember, they told us that our assets were $395,000. Our total liabilities are $97,000. So we need to solve for stockholders' equity or equity. So we need to solve for X. This is where the algebra comes in, folks. You better, if you need a refresher, tutoring is available. So we isolate the X, in this case is equity, and we find out that the value of our equity is 298,000. So remember, they presented us additional scenario. They said, well, what if equity increased or decreased by 65,000 and the other one increased or decreased by 35,000, I think liabilities. So if that were the case, assets were, that's what it was, decreasing by 65,000, liabilities was increasing by 36,000. So what would stockholders equity be then? So it would be less $101,000. So when we look at it that way, we find that our stockholders' equity ends up being $197,000 once we come up with the amount that it will decrease by, which is 101,000, and we just subtract it from the value that we had previously, if you can see there on the screen. So each equation, or not that each equation, but the equation is made up of various types of accounts. Various types of accounts. What are accounts? Accounts are storage units for our accounting data. So remember, going back to what is accounting, we identify the transaction and then we record and store the data. Well, this is where we record and store the data in our accounts. Our accounts show the increases and decreases that takes place from the transactions that we identify. And our accounts are areas that accumulate amounts. They will either continue to run along and increase and increase and increase, or decrease, decrease, decrease. Accounts are assigned to components of our accounting equation, and they help give a history of the company's financial data. So the accounts are where we would go to pull that data from what happened earlier this year or last month or yesterday based on the transactions that took place last year, last month or yesterday. So the first one that we want to take a look at is an asset. What is an asset? An asset is an economic resource that benefits our future operations. So it's something, a resource, an item that we use that increases or benefits our future operations. You could also consider assets something that we own. The item can still be financed and it's still considered our asset. So, in other words, if a company purchased a service, a delivery vehicle, and the delivery vehicle, the truck, cost $60,000, instead of paying cash outright for the delivery truck, they financed it. They went down to the local dealership, they took out a car loan, and so they're making monthly payments. Do they own the delivery truck? Oh, yes, they do. They may not have the title. That's only because the financing company is holding the title as collateral because you are paying them for using their money to purchase the truck. It's still yours because guess what? They're not telling Capital One to go pay for the tags. You own it. You pay for the tags, right? It's in your possession. So we've got to come out of that thinking that, oh, if I don't have the title, it's not mine. Oh, yes, it is. Because if it isn't, then you wouldn't be paying tags on it, property taxes on it, depending on what state you are in. Um, you wouldn't be doing a whole lot of stuff. What it is that you have made the decision to use another entity's money to purchase your asset, and thus you are indebted to them, that other entity, Capital One, and because a part of the agreement that you wanted, you said, here is my title. I will continue to pay you. You hold my title until I have finished paying you what I owe you. So do not confuse the financing of an item for your possession and that not being your asset. Oh, it's yours. It is yours. All right. And the asset in the company is used to create revenue. It is used to create revenue. So what type of assets do we have? Well, the first one is my fave, and hopefully it's yours too. Cash. Accounts receivable. These are accounts. Well, let me restate that. This is when I have provided a service or delivered a product to my customer, and I have said, you don't have to pay me now. You have 30 days to pay me. So now I am waiting to receive their cash payment. And so we call this accounts receivable. So instead of receiving cash, my accounts receivable increase because I'm waiting to receive the cash within 30 days. Supplies. These are supplies, sticky notes, pencils, pens, things that I use in my business to help in my operations. These are assets. Merchandise inventory. These economic resources are items that I purchase from a vendor or a supplier. So if I'm a retail store, if I'm Best Buy, I will go and I will purchase a refrigerator from LG and the washing machines from LG. I'll purchase 500 units of those. I will store them at my Best Buy. I will mark them up and sell them to customers as they come in through the door. That's what we call inventory. These are things that we buy to sell. We buy inventory to turn around and sell it. Prepaid expenses. This is when I would normally pay the expense on the due date. Expenses I would normally pay on the due date, I decide that I'm going to pay early or in advance of the due date. So this is when In businesses, this happens a lot. So instead of making monthly payments on their leases, companies will pay 3 or 4 or 5 years in advance for their lease or their rent. Insurance is another popular one that companies pay in advance. So instead of making monthly payments on their insurance to cover their business operations, they'll make a year in advance payments. They'll pay it all at one time every year, sometimes 2 years in advance. And by the way, for personal finance purposes, we would all save if you would pay your car insurance and home insurance in advance one time. They do give you a discount, but most folks are not going to sit around and pay a couple of $1,000s for their car insurance at one time. But it is cheaper than paying it monthly because they do add on fees to make monthly payments. So it's cheaper to pay one time. Anyways, equipment. The equipment that I own in my business, machinery, delivery truck, whatever that I own to help me operate my business, that is an asset. It helps me to generate revenue. The vehicle, my service vehicle, the company vehicle that is owned by the company, that is an asset. The building that I operate in, that I own, that my business takes place, that is an asset. The land that I've purchased that my building is on is an asset. Any patents, I'm in the business of inventing new things, or maybe I'm in the pharmaceutical business and I've created a new drug. I have patented it, it is mine. That patent, that license to be the only one who can use that particular tool or that drug, that is an asset. It may not be tangible, it's literally a piece of paper, permission to do it, but it is an asset. It's what we call an intangible asset. Goodwill is another intangible asset. That's when a company like, who was it? Google purchased YouTube before YouTube was a part of the Google family. They purchased YouTube for more than its market value, more than what it was worth. And so that created goodwill for Google. A copyright. If you're in the music business or literature, any sort of written musical works, even artwork, I think. I'm not too sure about that one. You can copyright so that people have to ask your permission to utilize that song or even parts of that song, that tune, any wording or phrases, quotes within your book or literary work. They have to either ask permission or either cite it appropriately and give you credit for it. And some people will make you pay, especially in the music industry. If you want to use a sample of their music, you got to pay. Pay up, pay up, pay up. All right. Liabilities. What is a liability? A liability is debt. That's the simplest way to come up with that one. It is the present obligation to pay cash, transfer assets, or provide services to others in the future. And so let me break this down just a smidgen. Present obligation. So I am obligated to pay either cash in the future, or I need to deliver a product to you in the future, or I need to complete a service for you in the future. That's a liability. So if I am one of your favorite artists, I don't know who's out there that's halfway decent. God, barely anybody. Um, I don't know. One of your favorite artists, and their concert is going to be in March of this year. Okay, you buy your tickets in advance so that you can get the best seating. Now, that artist, by accounting standards, is not supposed to use any of that money until when? Right. When the concert is at least 15 or 20 minutes is a good notion because, some of these folks will be fickle. The weather may not work for you and they cancel out, or, maybe they're trash at the beginning and you're like, oh, no, refund, whatever. So they are obligated. That artist is obligated to you. When you are doing a subscription like Netflix or Amazon, you pay in advance for that service. You pay that one time fee. It was $119 now for Amazon Prime. Well, gosh darn it, every day of the next 52 weeks, you are expecting to have Amazon Prime accessible to you and working, correct? So Amazon Prime technically should not even be using the $119 until they have fulfilled your 1 year subscription. Make sense? All right, so that's what we have there. Another thing that some say is the claims to the assets, and this is recognized by law. So that same conversation we had earlier about, okay, I went and purchased a delivery truck for my business. I financed it through Capital One. Well, they're holding the title. If I do not make payments, then they have already have the title. So all they got to do is do what, guys? Yes, come and repossess the vehicle. It's theirs. They have now laid a claim by me not keeping my part of the obligation. They now lay claim to my asset, and the particular asset is the vehicle. Same thing for mortgages. I'm not sitting around with $300,000 in my bank account. So guess what? I've got to go through a mortgage company or to my bank to use their money to purchase my home. Now, they will hold the deed and whatnot to my home as collateral, just in the case over the next 30 years I do not make a payment and they need to come and collect or foreclose on my home. You see how that works? So now they have a claim. That mortgage for the next 30 years is going to be considered a liability to me or to the company who is financing the purchase of their building. Why? Because they have made an agreement with the bank. I will pay you monthly for the next 30 years. You hold the deed to my property. In the rare chance that I will not make my payment, now you can lay claim to my asset, which is my building or my home, and foreclose on it. So that's what we're talking about there. All right. Creditors claims the asset. I just talked about that. So what are the different types of liability accounts? We have accounts payable. Accounts payable is a very popular account. What it does is business to business transactions. If I am an accounting firm and I'm going to Office Depot because it's tax season and I need to spend $10,000 on supplies to gear up for the tax season, I'm not going to go there and swipe a card or even pay a check for $10,000. More than likely, I have a accounts payable with them, a purchasing agreement where I come in with a purchase order and they allow me to purchase $10,000 worth of inventory from them, and I promise to pay within the next 30 to 45 days, whatever that agreement is. That's accounts payable. Businesses don't just shell out cash like that. And so what happens is that gives that business who made the purchase 30 to 45 days to make a sale, and they will use the sales money to pay for accounts payable, not money that they're already sitting on, because nobody wants to be what? Cash strapped. No one wants to have $0 in the bank because I went and I paid cash all across town for everything, and now I'm clicking on my computer and my desk waiting for a sale. I can't do that. You know why? Because I've got to pay my utilities. I got to pay my employees. I've got to pay my insurance. I got to still do those things regularly. So I'm not going to dwindle out my cash and make payments all over town in cash. No, I pay as needed based on making all of my purchases using what? Accounts payable. That goes back to what I said. Just because an expense comes up doesn't mean I'm just paying it with cash. No, I'm going to wait till the last possible minute as a company to make that payment. Why? Because I can't afford to be cash strapped. I will wait till I make a sale and use the cash from the sale to pay my utility bill than to take money from the bank that I may need to make payroll to pay the utility bill. You see what I'm saying? That's generally, I'm being very facetious here and very simplistic in my speak, but that's kind of the way things operate usually for a company. All right, unearned revenue. So going back to that scenario where you went and you paid a subscription, a yearly subscription to Amazon Prime. Well, on the reverse view, if I was Amazon Prime and I'm the company and I'm selling subscriptions, if I'm Amazon, I'm selling Amazon Prime subscriptions, all of the money coming in from all those cards making those $119 subscription purchases will go into this account called unearned revenue. I have not earned that revenue. Why? Because a year hasn't gone by. I have not provided a year's worth of Amazon Prime service to said customer. So that's what unearned revenue is. A customer has paid me in advance, but I have not provided the service or the product to them as of yet. So it is unearned earnings. It is not earned. Notes payable. This is another word for loans. We don't say loans in accounting. We call it a note. And I'll talk about why later on when it's a little bit necessary, but it is a note. This goes back to historical context. If you're aware of, if you're like me and love those BBC movies, Emma and Pride and Prejudice, and you're talking about all of how economy and commerce used to happen, then you kind of have an idea of where the note came from. But it is a loan. Long-term notes payable, because not every note payable is a long-term note. A long-term note means something that's a note or a loan that goes beyond a year. This is where you find the mortgages and installment notes, those long-term, 3-year, 5-year, 10-year, 20-year, 30-year, 50-year loans. Taxes payable, yes, taxes. Any sort of payroll tax is a liability for the company. Um, any taxes that they have to pay, that's considered a liability. Any payroll withholding are considered liabilities. We hold them until we pay them to the government entity every quarter or every month if we have to. Interest payable for a company. Interest is a separate liability from the actual note. So whenever you see this word note payable, that does not include interest. Interest is its own separate account. They're not mixed together. So there's the note. If I take out a $50,000 loan, that's the $50,000 goes into notes payable. But the interest that I have to pay on that $50,000 is goes into another account called interest payable. Wages and salary payable, because you don't get paid every day. And if you do, just be quiet. Don't say anything. I'm not talking to you. But even if you're paid once a week, what you earn in the previous week is set in a holding account, and we call that wages payable until your payday. Another one that's listed here that we talk about in 242, but it's not important for us here, is a bond. Bonds payable, and that is a form of a way of generating capital for a company. So bonds payable is another one that goes here, and I just forgot to list it. All right, and then lastly, we have equity. What is equity? Basically, it's the difference between our assets and our liabilities, whatever is left over. That's our net worth. It is the owner's claims to the asset. So remember, owners can buy into a company. How do they do that? Through purchasing stock, common stock, right? So our contributed capital plus our operating capital, that is our equity. Capital that is contributed through sale of stock, and then capital that the company earns through the sale of goods and services. So contributed capital, we're talking about the sale of ownership. That's one way that a company increases their equity. And then the other way that a company increases their equity is through the sale of goods and services. Those together make up equity. So, what are the different types of equity accounts that we have? Well, we have what we call contributed capital. And underneath contributed capital, we have three different types of accounts. We have common stock, preferred stock, and treasury stock. For the purposes of this class, we're only going to talk about common stock. The other two we talk about in Principles of Accounting 2. Then we have our retained earnings, which is considered our operating capital. And we have three accounts here: revenue, expenses, and dividends. So notice here that revenue and expenses, dividends, those are not assets. Those are not liabilities. That's not debt, folks. It's equity. This comes from operations. What did I sell? What did I not? What did I sell? Revenue is what did I sell? How much did I sell? And expenses are what are the bills that I incurred to make these sales happen? So revenue, write this down. Revenue is what did I sell? What was the value of the goods and services that I sold? And expenses are, well, what was the cost? What are the bills that I incurred to sell those goods or services? Okay? You see that? And then dividends is just a kickback to the stockholders, the folks who purchase the common stock. We like to make them feel warm and fuzzy and say, hey, thanks. Thanks for your contribution. Here you go. We're going to give you a quarterly dividend, blah, 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 whatever. And depending on how many shares that they own, it may be a good quarterly dividend or a meh quarterly dividend. All right. And so that is what we consider our accounts for the accounting equation. So let's just kind of do a quick summary here and go through and see how this applies. Indicate which of the following is identified with an asset, a liability, or stockholders' equity. So 1, 2, or 3. So accounts payable, that's a liability. Cash, that's an asset. It was supposed to be separate. It's coming up together. Well, you get the point. Fees earned, that is stockholders' equity. That is a type of revenue. Fees earned is a type of revenue. Land, that is an asset. Supplies, that is an asset. Wages expense, that is an expense, which is a type of equity. And here we have our stockholders' equity, and this is, this is the how the stockholders' equity section is impacted by our expenses, our revenues, and our dividends, and our common stock, which we call stockholders' investment.